All right. Hi, everyone. Good morning. Good afternoon. This is Michael Tsan speaking. And this is the asset financing pay-as-you-go models and fuel sale-centered models session. So I just want to welcome everyone. Quick introduction. So I am a partner with Dalberg Advisors. I co-lead Dalberg's energy practice globally. And I have been working on the clean cooking sector, clean cooking issues for the last decade. We have a great panel. Who will introduce themselves in a bit more detail, but we have Ben Jeffries from ATEC, we have Philippe Hoeblich from PayGas, and Lesley Marincola from Angaza. And apologies to the panelists if I'm butchering your names, but I'll give a bit more context on what this panel is about before I turn it over to the panelists for their introduction. So the core of what we want to talk about in the next hour, and we're going to present for we're going to have a panelist discussion for about 35 minutes or so, and then we'll turn it over to audience questions. But I just wanted to note that if you please do send your questions into the chat earlier, we'll be monitoring those and answering those either as they come up or in the Q&A that follows. The purpose of today's conversation. So we wanted to explore the potential for business model innovations, including asset financing, pay-as-you-go models, incremental fuel sale-centered models, to unlock critical demand and supply challenges and the broader uptake of clean cook stoves and fuels. And the reason why a lot of us are excited about these models is that they create breakthrough opportunities for such challenges as fuel stove affordability, access to consumer finance, certain operational bits such as client relationship management, ongoing after-sales support, and less directly may unlock interesting innovations such as results-based financing and the potential for other kinds of financing innovations. On the flip side, adopting such models has some challenges, and we'll talk about both the opportunity and the challenge that these models present in this conversation. So with that, turning it over to the panel to introduce themselves and talk a little bit about who they are, their organization, and their business model, and kind of how they enter into these questions. So perhaps starting with Lesley with Angaza.
Sure. Can you hear me? Thumbs up. All right. Great. Good morning, good evening, wherever you are in the world. My name's Lesley. I'm the CEO and one of the co-founders of Angaza. So Angaza is a San Francisco and Nairobi-based software company. We have a mission to equip last-mile distributors with the technology they need to offer life-changing products, anything from solar home lighting systems to clean cook stoves, to offer those products to consumers anywhere in the world. So think of us as basically the software platform provider. We partner with last-mile distributors to digitize their business and automate their workflows. Today, Angaza works with over 200 distributors all over the world. Most of them are in sub-Saharan Africa, though, with a large concentration in both East and West Africa. And to date, we have over 2.5 million consumer accounts on our platform. The vast majority of those accounts are pay-as-you-go loans to consumers. And we've registered over $200 million in consumer payments thus far. So it's, especially over the last couple of years, been really amazing to see the growth of the last mile distribution industry. And again, the innovation, pay-as-you-go being one of them that last mile distributors have used to reach more consumers. Just to give you a little more sense of what Angaza does here, we work with distributors of all sizes. So from small businesses just starting out and looking to digitize their business, all the way to very mature enterprise level businesses that work across multiple countries and have pretty complex needs when it comes to their operational workflows. You can think of us doing basically 4 primary things when it comes to the software that we provide. We help last mile distributors digitize their business all through a centralized CRM system. So you can really know your consumer, track information on that consumer, and be able to provide after sales support to your consumers. We help distributors manage their sales network to basically help train their agents, optimize their sales agent network, and even track inventory as it moves through various retail points or individual sales agents. Like I said, the vast majority of our customers do offer pay-as-you-go. So a big piece of what Angaza does here is help them actually collect mobile payments, track those payments over time, and really monitor their ongoing loan portfolio. And then last but not least, we really help distributors gain real-time data insights into their operations and basically power a lot of just data analytics to help distributors, again, understand their consumers and make better operational decisions. So why am I here on this panel? We, like I said, work with distributors that offer a wide range of life-changing products, anything from solar home lighting systems to clean cook stoves to metered smartphones to home appliances. And many of these distributors are offering pay-as-you-go financing, which is a business model with a lot of opportunity, but also with a lot of complexity, which I think we're going to touch upon in this conversation as well. So again, really excited about the clean cook stove sector. I think in the last couple of years, we've seen just a lot of innovation, a lot more clean cook stove distributors really looking to digitize their business and start to offer consumer financing. And I think the clean cook stove industry itself sits in a very unique place because it's not just traditional pay-as-you-go that we see businesses trying, but a bunch of different types of asset financing as well, which I'll touch upon soon in the conversation. So great to meet you all. Thanks.
Wonderful. Let's go to Ben next.
Great, thanks, Michael. Hi, everyone.
Wonderful. I don't know if people can still hear me. Let's go to Ben next.
Yeah, great. No worries. Hi, everyone. I'm Ben Jeffries. I'm the CEO of ATEC International. ATEC provides last-mile households with PayGo-enabled biodigester systems that convert animal manure and other waste into biogas for cooking and organic fertilizer for farming. We have subsidiaries in Cambodia and Bangladesh, and they're building out our capability to scale our technology out into other countries in the future. We see PayGo as one of the keys to unlocking scale within access to modern cooking globally. We see it has a lot of potential of opening up new payment options for customers, as well as new ways to be able to convert customers and trial new ways of promoting, particularly when you're looking at bringing new households into modern access to modern cooking as well. We're based out of Australia. We work with Angaza as our PayGo software provider as well, and are looking forward to this discussion today. Thank you.
Wonderful. Thank you, Ben. Hi, Philippe. Over to you if you're able to just introduce.
Yeah, okay. Thank you, Michael. So I'm Philippe. I'm the CEO and co-founder of PayGas. PayGas is a startup, is a French technology and a South African startup who is distributing affordable clean cooking, LPG, to millions of low income. So the challenge of LPG, as we know, is people they don't always have the money for buying a full cylinders when it's empty. Regardless the size of the cylinders, I don't have the money, always the money when my cylinder is empty. So we have developed and deployed in South Africa cashless refilling station. You come with your cylinders with our technology. You pay with a cashless solution. You pay $1, $2, and you fill exactly the amount you pay for. So the name of the technology is Pay-as-you-gas. And we have been quite successful. We are only operating about 18 months. We already have more than 5,000 monthly clients, deploying 3 stations, selling more 100 tons of gas. And yes, the reflection about asset financing is very important because there's different type of technology in the LPG, and CapEx has always been a big challenge for LPG industry. So very happy to share any experience with the panel regarding CapEx and asset financing for LPG clean cooking. Thank you very much.
So maybe a good starting point before we talk about some of the complexities. A good starting point is talking about why you chose to pursue pay-as-you-go asset financing or pay-as-you-go more broadly models. What kinds of things were you trying to solve for in adopting that model, and how well have you seen it work? So maybe Philippe, just continuing with you, and then over to Jeff.
Okay, thank you, Michael. So yes, the problem of LPG industry is, as I said, you need to buy a full cylinders every time it's empty, regardless of the size. It could be 5 kg, 9 kg, 12 kg. When it's empty, you need to buy a full one, and you don't have always the money in your pocket to buy for a full one, especially because you don't know when it will finish. And why industry is imposing you to buy a full cylinders is because of the capex involved. To get a client like Michael, I need about 4 cylinders in rotation, what we name working stock. So when you come at the shop with your empty one, I need to have a full one ready for it. But to have a full one, I need one going to the filling plant, one at filling plant, one coming back. If each cylinder is about $20, I need to mobilize about $80, $100 per client to get one client. So the cost of acquisition is quite high in terms of capex. So that's why I asked you, Michael, to buy a full one. But it prevents most of the people to buy it, especially in low-income households. So if you change the technology and reduce the capex, then it makes more accessible. So that's what we are doing with the technology, is only 1 cylinders for 1 client. And that's the way we finance our station, is by making a lot of saving to the gas partners, by reducing their capex, reducing their OPEX, and taking all margin from the suppliers. So, and they invest in the capex on our model is on filling station, and it's co-financed with a gas company. So it's a real prepaid model. If you don't have money, Michael, you don't go at the station. So we don't give a credit, you don't build a credit for the client. It's really a prepaid model that prevent quite a difficult situation in terms of financing. So that's why we choose this pay-as-you-gas model, to avoid any credit issue and challenge, especially when you are selling to low-income households. So that is the experience we got in terms of financing the assets in PayGas.
Thank you very much, Philip. Ben, maybe over to you. I mean, how were you thinking about your move into PayGo and your partnership with Angaza, and how has that worked thus far?
Yeah, so that was an interesting one, because we didn't start off doing PayGo from the start. We existed for quite a few years before bringing in the PayGo technology. I mean, I think we encountered a problem that anyone working in biogas has as well. The small scale is that you are very much doing a purchase of an asset that provides a return on that asset over time. So part of that challenge with biodigesters or biogas is always, how do you try and break down the cost of that asset, because it can be a fairly quite expensive asset for a household in a developing country, but break that down in order to match that up with the returns on that asset over time, make it more accessible. So the traditional way that many of us have worked in the past is around using microfinance as a partner to be able to break down the cost of that over time. What we saw in Cambodia, where we kicked things off, was though that there was many challenges in working with microfinance partners in that context as well, particularly as you started to scale up. If you can get a great partner, that's fantastic, but we saw in Cambodia in particular many challenges around working with microfinance, particularly around value for money for the customers and collateral requirements as well. So it made it quite unattractive for customers to finance their purchase of a system through microfinance. So quite often we'd see about a 50% cancellation rate from customers who wanted to buy a biodigester, who then went through to actually using microfinance. The other challenge we saw there is that sometimes that process may take a week, but quite often that would take 3 or 4 weeks, if not longer, and require a lot of chasing from our side. So for us, converting over to pay-as-you-go was quite a logical decision. We saw the success it had in the solar sector, and we saw that it could offer a much more straightforward, lower risk opportunity for customers to be able to access an asset like a biodigester and then be able to pay it off in smaller amounts. For us, it's about $1 a day. That matches more closely to the savings they achieve over time.
So that's on the benefit side. What if anything was challenging for you?
Yeah, I think, I mean, if you're going from being a traditional sort of sales, marketing, distribution company, doing product very much like we were, you're then effectively building out a second business around asset financing. So to be able to manage that effectively, you need to be able to have the payment policies and procedures in place to be able to ensure that you're not just selling assets, but that you're actually then collecting the cash from them over time. The big assumption or the big challenge we had when we got into this was we kind of had a good idea of what the default rates were within the solar sector, but what was that going to be like in the biogas sector? When we sort of kicked it off, we're the first in the world to do it. And roll it out commercially. We weren't quite sure how that was going to look. But what we found is that probably, well, from what we've seen, we've been outperforming the solar sector as far as the repayment rates go. And we think that's because a biodigester, you're not just sort of, you're solving two problems in one. You're solving the access to modern cooking problem, but then you're also solving a agricultural problem. So bringing those two together gives quite a strong return on investment for the household. So we've seen very low default rates, very good payment rates over the time. It's exceeded our expectations, which is great.
Philippe, what has your experience been like with repayment rates? I know it's early days, but I was still curious. Philippe, I think you're still on.
Okay, I think it's good. Yeah, what is interesting with PayGas, Michael, is we don't give credit to client because I've lived 25 years in Africa, and giving credit to low-income family is really an expertise that we can have as gas distributors. So, as I said, one of the problems on the LPG is you don't want to put your asset into people's house and waiting for people to pay for it. So what we do is the cost that client need to take is a deposit. You need to pay the deposit, and then you can finance. You can pay for what you can afford. So we completely avoid putting assets to people's house and to our client to avoid negative cash flow. So we do a real prepaid. It's like for airtime. If you pay upfront, and then you can consume. The only thing that we do is we reduce the entry barrier at the lowest. You can buy PayGas for 50 cents, but if you don't have 50 cents, you can't buy. So we avoid any credit to the client to avoid these challenges that people in low income, they are low income and not regular one to reimburse. So we choose to avoid any credit to the client.
So the stove and the cylinder is never fully the client's done at the very end in your model.
Yes, in our model, you need to buy the cylinders. And you know what was, I was very surprised because when we do the inquiry, 98% of our clients say the deposit is not a challenge. The problem is this minimum amount to pay every time is empty. So they can gather the amount about $20 for a deposit first time, but they can't have this $20 every month. So this is a big, just by listening my client and understanding that, yeah, they're ready to pay for the deposit, but not for a minimum amount every month. So, and I thought at the beginning that deposit was a challenge and a barrier, but it's wrong. Based on the experience we got in South Africa, it's not a problem. The deposit is not a challenge. The challenge is a minimum consumption.
Very, very helpful. Maybe turning to Lesley, as you see companies like ATEC exploring the integration of PayGo into their business models, how difficult is it to integrate PayGo and functionality into clean cooking business models? And maybe then also just comparing that to what you're seeing in the solar off-grid space.
Sure. So I'll answer this question in a couple ways because we see the manifestation of pay-as-you-go, again, in a lot of different ways, actually, in the clean cook stove space. So the most common model we see actually is typically a lot of cook stoves are pretty low retail value. So distributors are selling the cook stoves either at retail value or at product value or even below product value. And then they're recouping the cost of that clean cooking device over time through the sale of fuel or pellets or what have you. So the reason this is the most common model that we see in the clean cooking space is because actually most of the clean cooking devices that are sold are not actually electronic products. They don't have a battery, they don't have a circuit board. So you can't actually embed, smart metering technology in the device itself. That being said, we're actually seeing a lot of innovation around basically upscale clean cooking devices that are electronic, that have a higher retail value and do often need this embedded pay-as-you-go technology to be able to enforce the consumer financing loan that comes with the device. So I'll touch upon what that means. Basically, when I refer to embedded metering and monitoring technology, this can come in a couple different forms, but the most exciting that we're seeing in the cook stove space is being able to actually remotely monitor the device no matter where it's sold. So this can be done through actually embedding a GSM module and SIM card into the device itself. You're essentially turning a clean cooking device into a cell phone in a sense. And that allows you to actually apply payment information to the device to activate it when the consumer has prepaid. And you can also monitor usage of the device. And I think later in this conversation, we'll get into a little bit about what you can do with that usage data. So that's an application that we're starting to see in the clean cook stove space in terms of actually embedded metering and monitoring pay-as-you-go technology. There are two other operational models we frequently see as well. And those are called product bundling or remetering. So product bundling is also a common model in the clean cook stove space where maybe you're selling a solar home system that does have that embedded metering technology in it, but the loan value includes both the solar home system as well as the clean cooking device, even though the clean cooking device itself might not be electronic, so there's no actually metering component in the cooking device. It's basically enforced as through the bundle of sale with that solar home system, for example. Lastly, I'll touch upon this concept of remetering, which is another common form of what we see here. Remetering is a concept where, for example, a consumer may have paid off a loan for a solar home system. A distributor actually has the ability to remeter that solar home system, put it back in a metered state to actually act as collateral for the sale of the clean cook stove. So again, if you can't actually embed metering in the cook stove itself, you can do so through other devices to act as collateral there. So again, a lot of different types of pay-as-you-go innovation we're seeing in the clean cook stove space. And a lot of it really depends on exactly what device you're selling, what the retail value of that cook stove might be, and whether that cook stove is electronic or not electronic.
So before we can explore a bit more of what needs to happen to scale these kinds of models in the clean cooking space. Just curious, as a follow-up question, Lesley, the bulk of Angaza's work is probably still in the off-grid solar space. There have been some great successes in PayGo in the off-grid solar space. There have been some failures. Are there any lessons from what you've seen with PayGo models in the off-grid solar space that are applicable to anyone who's thinking of applying them in the
Absolutely. So there's a ton of similarities between the off-grid solar pay-as-you-go space and the clean cooking pay-as-you-go space. I think the first advice I'd give to any business that's starting to think about pay-as-you-go is make sure you first have a plan and a process to just digitize your business in the first place. So be able to actually track consumer information, collect consumer data, know who your consumers are, and make sure you can contact those consumers over time via SMS, for example. And the reason that's so important is the first step. We've seen a lot of companies in the pay-as-you-go off-grid solar lighting space often jump too quickly into pay-as-you-go, and they don't have some of the basic digitization processes or even sales agent training processes in place before they're making their model a bit more complex by offering consumer financing. So that's kind of the first lesson I would say is some businesses are just not ready to offer consumer financing yet. It's a hard model. Again, there's a ton of opportunities. You're able to reach consumers much more quickly and be able to create that long-term relationship with consumers. But it does require you to basically act as a financial institution. So that's the first lesson. I would say the other just learning that is completely applicable from the off-grid solar space to the clean cooking space is a deep investment in sales agent training. So by sales agent, I mean basically the retail point, whether that's an individual or a shop that's actually interacting directly with the consumer to make the sale and process ongoing payments. You can kind of imagine a game of telephone here where you have to train your sales agents to be able to sell pay-as-you-go, help the consumer understand, what they're paying for and how they make payments. And if that game of telephone breaks down at all, basically something is going to go wrong in your supply chain. So that's kind of a big lesson. And lastly, I would say is really just the need to manage your capital wisely. Pay-as-you-go, one of the big opportunities here is that you can sell more devices more quickly because you're lowering that upfront retail cost barrier of the devices. We've seen distributors sort of struggle under their own success in the sense that they sell devices too quickly. And then they have to actually sit on and wait for the repayment from the consumers before they're able to actually purchase new inventory. So being able to really think about your cash flow a little bit different and manage your capital, I think is a big component that's, again, directly applicable from off-grid solar to clean cooking.
Very, very helpful. Some really interesting insights there. I guess turning to the question of, given the potential of PayGo in the clean cooking space, what needs to happen? What are the barriers to just much broader uptake of pay-as-you-go? I think some of those barriers Lesley was touching on right now in terms of what clean cooking companies need to do before they're ready to adopt these kinds of models. But maybe turning to Ben first, is there anything that the broader clean cooking community needs to do to unlock PayGo, the PayGo opportunity for the clean cooking space?
Yeah,
what's preventing these models from having a lot more uptake? Is it just early days, or are there any structural barriers?
Yeah, cool. It's a good question. I think if you look more broadly overall at trends, both in developing countries and globally, I don't think PayGo is just something that will be sitting with just solar or just moving into cooking. I think it's going to be a general trend of a multitude of different assets as they begin to get upgraded, being offered PayGo options to be able to do that into the future. So I think as far as a way of purchasing assets, it's going to be more and more common as we go forward across everything. I mean, I know, for example, people are trying PayGo with purchasing motorbikes. For example, in Cambodia is one option that we're seeing as an alternative as well. So it's I think that broader trend is where it's going, and why is that broader trend happening? I think it's very much because it offers a very straightforward way for people to purchase an asset, but break it down into manageable, smaller payments for that customer over time. I mean, there is two types of pay-as-you-go. There's the breaking down of an asset cost into smaller amounts, such as what we're doing. If I understand Philippe and his work, it's sounding more like you're kind of paying as you go for the access to that particular service. So I think it's important to identify that there's two types in there as well. We're on more the asset side. The challenge you have as such is, I think for business to take it up is, as Lesley mentioned, it's not a straightforward business model, particularly if you're coming from a direct sales and distribution perspective. There's a lot more sophistication and integration you need to do to be able to run as a PayGo business as well. You need to be able to bring together various components, such as the software side, the hardware side, the mobile money payment side, etc. Be able to bring that all together successfully, and then make sure that that's all running smoothly. Probably the second point that's probably even more important is then what happens when people don't pay. So if you're relying fully on the reinforcement through, say, the hardware mechanism of it switches off or whatever the case is, you're probably going to get yourself into trouble pretty quickly because people are quite quite intelligent in trying to figure out ways to bypass that as well. So we very much see the PayGo as a big part of the process, but not the sole process. Our late payments procedure is critical to our success of being able to do things. So working with someone like Angaza is really helpful because you can set up automated text messages, it's prompts, but we also have a PayGo service team who also have again, as Lesley mentioned, we have that set up through some of our processes so that they're calling them sort of the day after they've missed the payment, and then at 5 days, and then 7 days, or whatever the case may be. And then if payments are not coming through, that we're right on top of repossession. Because if people see that they don't make payments, but we're not collecting that asset, and then potentially they might be figuring out ways to override PayGo or whatever they are into the future, then you could quickly go from a very small problem to an incredibly large problem very quickly. And we've seen that happen with a PayGo solar provider in the past as well. So we quickly took the lessons from there that you've got to be right on top of repossessions as well. So we've not had those issues so far, which has been great to see. But I think that's a big part around our late payment policy and procedure there. If we weren't right on top of that, I think you're asking for a world of trouble.
That's extremely helpful. Sorry, I'm just going to get up a video here to get a stronger connection. Philippe, over to you on kind of a similar question. When you talk to investors, and even more importantly, when you talk to the broader LPG sector, you talk about a multi-billion dollar. Apologies. So it's a multi-billion-dollar industry. What is the greatest point of skepticism that you face around the applicability or the feasibility of the sort of PayGo utility model? Essentially, is what you are doing. What are the biggest questions that you face in terms of the potential for this model to really scale in the LPG sector?
So it's a good question. First, I would like to thank Ben, because the first question that the gas company are asking is it sustainable? And Ben clearly mentioned that when you go on the PayGo model, is it a postpaid, meaning that you put your asset, you give a loan, and you are paid monthly by your client, or is it a prepaid? Postpaid model in PayGo is quite risky, as Ben said, because you put your asset, you wait for the payment, but people, they don't have money, and they don't choose to not having money. So it's just a situation. And what happened? You need to do the collection on your asset on the roof or on the house, if it's like a gas cylinder. And the prepaid model is, I would respect you as a client. If you only have 50 cents, I will make it for 50 cents, but you need to pay it. So I think that sustainability, especially on industry like LPG, where there's a lot of capex, you need to be profitable. The profit is long-term. So meaning that the first thing is, okay, I will come and create a blue ocean. Who are the non-client of gas today and why? Why? Because Michael can't pay a full cylinders when it's empty. Okay, then I will prove you as a gas company established for 60, 100 years that there's still a market. And it's a market that will cost you less than the traditional market. So, and it was very interesting because the capex on cylinders was a very funny story, because the first time we reached 100 clients, I ordered about 400 cylinders. And the CEO, the country CEO, called me and said, Philippe, please order more cylinders because you already reached 100 clients, so you will be short of cylinder. And I said to my friend, Walter, I say, no, I still have 300 cylinders. So even if big company understand, they are so focused on capex because it's capex intensive industry that don't realize that you can divide by 4 the cylinders requirement per client. And it's only through the pilots that we did and reaching about 50 tons, 60 tons that they say, wow, it really works for us. And they are making more saving in terms of amount than even if what you sold as a LPG. So yeah, for long established industry, you need to do the proof of concept, traction, and scalable. Scalability is very important because gas, the risk is hazardous product. So how do you decentralize the refilling and maintaining the same safety procedures? And that is the main challenge for gas because safety first. So, and if you prove that you are safer than their own installation, then you make the deal. You are the game changer. So safety and profitability are very important for convincing LPG, big major LPG company.
Thank you very much. I think that's very clear. Maybe turning to one or two more questions, just looking at the time here. If you think about some potential co-benefits of adopting pay-as-you-go models, either models that actually have a embedded GSM chip in the clean stove or in the bundle, and so you can actually see what's happening in the household, or just using the payment stream as a proxy to track use and uptake of clean cooking solutions. Just talking about some of the co-benefits and opportunities that may create. One thing that we hear about quite a bit is the ability of pay-as-you-go models to synergize with results-based financing because they can lower verification costs, either for new kinds of results-based financing models that are being put in place for clean cooking specifically, or for existing carbon finance schemes. Just wanted to see how you are thinking about that. Maybe starting, Ben, with you.
Yeah, it's a good point, Michael. I think we're probably a little bit ahead of the curve here as far as the sector goes and the uptake of such an option. I think if you look at two things, I mean, we have results-based financing partners and we also registered for gold standard carbon credits as well. In both those situations, we've gone to both those partners and said, oh, well, here we've got this customer payment data that we can use as verification that the systems are being used as intended, etc. This could really rapidly accelerate our verification procedures as well as reducing the costs of traditionally they would be sending out consultants to go and do randomized checks or whatever on the that systems are actually being installed, the data that we're providing to them is actually accurate, etc. So we've gone to them and said that, hey, this is a much better way to do it. And they're like, oh, this looks great, but we're not quite at that point of being able to use the data in that way. So we're hoping that that will change in the next couple of years. Particularly if you look at, say, carbon financing, it's not the cheapest thing to be able to get that verified each individual time. So the fact that we could just go, okay, well, here's the systems, here's the data showing that they're being used and implemented as they should be, then hopefully that could become quite a quick tick process from there. So I think it's got a lot of potential, but yeah, I think we're probably ahead of, say, some of those third parties as far as those procedures, but hopefully they're catching up soon.
And maybe building on that question and turning to Lesley. So often when you talk to people who are running RBF schemes or carbon financiers, they're looking for points of integration or aggregation because what they see is a very fragmented space of vendors. Is there, how do you think about this as an opportunity for Angaza of being kind of an entry point to, let's say, carbon finance or RBF that multiple enterprises can then access through you?
Yeah, exactly. And I would just pause and say, I think the clean cooking space has a huge opportunity here when it comes to carbon finance. Going back to previous questions you asked me about the off-grid solar space, you can claim so many more carbon credits with the sale of a clean cooking device than you can with the sale of a solar home lighting system. So if you're not already thinking about it, definitely a great opportunity to think about. So yeah, Ben touched upon a lot of the points here, but I think really what the digitization of your business and the introduction of pay-as-you-go does, specifically with results-based financing and carbon finance, is you're switching from a model where in order to claim the credits or get paid for your work, instead of having to run very expensive, in-person survey teams to go talk to the end users, make sure they have purchased a device, make sure they're actually using the device. Your world can literally look like a click of the button that you submit to, a third-party entity to claim those credits or get the results-based financing. So that's really a role that Angaza is trying to play here, is just make it super easy for distributors. Again, if they've done that process of digitizing their business and tracking consumers over time, to be able to just export that data and have that data be super understandable for various entities, including carbon finance entities. The benefit is because you need the manufacturer involved as well as the distributor if those aren't one and the same business. And so, from Angaza's standpoint, we're looking at partnering with manufacturers on the carbon credit side, so their products can be certified such that any distributor that sells their products can then basically take part in the payouts there. So basically really kind of playing that marketplace and building up that ecosystem to make this accessible to any size distributor.
Michael, if I can, I might just add a quick point here because I think this is a relevant one. One thing that's being done at the moment, I think it's called the World Bank Multi-Tier Framework, which is like a baseline study on, I think it's cooking and other access to energy tech as well. Is one thing I think we need to probably get a bit more advanced on is we're going to see more and more enterprises like us and PayGas and others who will be operating across multiple countries and looking to scale out quite quickly. One of the holdbacks in RBFs and carbon financing is it's very based on a single country kind of model, which then becomes a challenge if you're starting to scale out across multiple countries. You need to verify each individual country. So I'm hoping that sort of baseline work that's being done by the World Bank could help rather than going through this very elaborate process each time of being able to just use that baseline and open up more results-based financing, carbon financing in the future.
Yeah, no, that makes a lot of sense. So we're on time, but I'm seeing questions coming from the audience. I'm going to just build in and keep the dialogue going for a little bit longer. So we talked just now about carbon finance and results-based financing and the synergies between those and pay-as-you-go. There are potentially broader other co-benefits from a financing perspective to pay-as-you-go that go beyond carbon finance and results-based finance in terms of presenting an ongoing payment stream to investors and providers of kind of debt capital as well. So maybe a question to Philippe, are you seeing any co-benefits from that perspective, right? Because it is a CapEx savvy model of being able to present this ongoing stream of payments and being potentially able to collateralize that with financiers. And then building on that more broadly, a question from the audience on, is there value to creating a bit more transparency around pay-as-you-go KPIs for the clean cooking sector in the way that has now been done to some extent in the solar off-grid sector as a way of offering or bringing more investors in and bringing more capital in more broadly? So maybe starting with Philippe and then turning to others.
Thank you, Michael. Yeah, so I'm very old school. Maybe the oldest in the room. So for me, long term is as I say, is bottom line. So the sales of my product should generate enough profit so I can continue to work. I can continue to scale. And the model we've developed is, well, after 18 months, we are almost at the break even. Like we reach about 90% of the break even. So on the monthly sales, so my monthly sales is covering 90% of my overheads already with 3 stations. So the way you build your model is very important that you generate enough revenue and enough profit to make it going on. So the co-benefits, as my industry is CapEx intensive, if I go to you, Michael, and I say, look, I will reduce your cost by 75% in CapEx, share it with me. Just share the saving. We do 50-50 on the saving. So give me a better price because gas is commodity. So if you can sell me a better price because I make you saving 75% of the CapEx, that's a real deal. So as a startup, you got an asymmetric relationship with the big major company. So, and the way to work is collaborative strategy. I'm approaching gas company, anyone, let's say, guys, I will save you 75% on your CapEx and 40% on your OpEx, on distribution cost. Are you interested to partner and co-finance my CapEx? So I think it's just basic things that work on a collaborative strategy, look how people can support you by saving them money. And it's concrete. So that's how it works for us. Synergy co-benefit is all gas partner, because you can deploy the most efficient energy inclusion network with the maximum impact at the lowest cost. So, but it's specific to my industry with CapEx incentive. So I think we will look on existing partners, existing stakeholders, and what is wrong and why people are obliging for minimum consumption. It's not because they are bad, it's just because they got costs. So I think it's good to go deeply in each industry to understand it and work together, because I really believe in collaborative strategy. So that's the co-benefits we're bringing at PayGas and how we're sustainable in our business.
Yeah, no, that's very, very clear. It's very clear. Maybe on this question of KPIs, benchmarks, pay-as-you-go benchmarks for the clean cooking sector, and whether that can, at least for asset financing pay-go models, where can that really begin to unlock things, especially if, as Ben was, I think, mentioning, he's seeing repayment rates that are better than the averages you would see in the off-grid solar sector. Lesley, do you have any perspectives on that? Because I know that you've thought about, pay-go benchmarking quite a bit.
Yeah, absolutely. And let me give you a sense first of what has happened in the off-grid solar lighting space around KPIs, because I think the clean cooking space can definitely replicate a lot of those learnings. Essentially, a couple of years ago, a lot of the various industry players all got together and said, hey, we've been using microfinance KPIs for a long time to basically report out on our metrics, on our operations. But we're seeing just a lot of variability in terms of how different entities, whether it be a funder or a distributor, how they're actually interpreting those KPIs. Because in the microfinance industry, if you think about a cash loan, often the operational model is you're expecting to collect a specific amount of cash on a specific date with a specific interest rate. With pay-as-you-go off-grid solar lighting, the payment schedules tend to be a lot more flexible. It truly is pay-as-you-go, and you're never really seeing that consistent consumer payment pattern where they're paying, on the dot every month with a specific interest rate. So what happened in the off-grid solar lighting space is basically the industry association, a lot of industry players got together and said, let's basically adapt microfinance KPIs to our industry. Keep a lot of them that work, but change a lot of the KPIs we track. So it's not just, traditional portfolio at risk now that has been adapted to the pay-as-you-go model. And I think the same thing is starting to happen in the clean cooking space, because I don't think that, even in the clean cooking space, that we should use the same KPIs that the off-grid solar lighting space uses, because again, people think about default rates different. There's different operational models through the sale of, fuel and pellets over time to basically pay for a device. That's quite different than the off-grid solar lighting space. So I think what really needs to happen is basically have this be an industry movement to develop a shared set of KPIs. And then that unlocks a lot of financing for companies, because then you're able to talk to funders with a shared language, again, export your data under a certain framework that makes it very easy to report out on your metrics. And I think it would really just benefit the industry as a whole to be able to just channel a lot more financing and to be able to, track metrics in very similar ways across industry players. So this is still an ongoing project in the off-grid solar lighting space as well. I don't think it's ever, a done, complete set of KPIs.
Right, but I think some really interesting lessons there, and I think an important call to action for the clean cooking space. Absolutely. So we're going to turn it over to the audience, and we're getting a lot of questions already that I'm going to start kind of voicing here. Many of those questions relate to this carbon finance opportunity and how it links to pay-as-you-go. So one question for you, Lesley, as for the Angaza platform, are you already integrating in some way, shape, or form with carbon methodologies and registries like Gold Standard, given the carbon finance opportunity for PayGas?
We haven't done a lot of that directly, but it's something we're eyeing very closely because, again, I think this is a huge opportunity in the clean cooking space. The way we're going about it right now is partnering with third-party entities that have these basically robust methodologies, certifications, reporting standards, and connecting the Angaza platform to their systems to be able to export and share the data that you need to be able to, again, claim the credits and participate in those types of financing schemes. So that's how we've been connecting clean cookstove distributors to those types of companies. Angaza doesn't do that.
Sorry, hopefully people can still hear me. Similar question to Philippe. So the question from the audience was, LPG does not typically benefit from carbon finance, but is there anything which is being done along these lines for LPG and carbon finance? Is there an opportunity here of some sort? So yeah.
Yes, clearly, Michael, there's a huge opportunity in the sense that, as Lesley said, because we digitalize each of our clients, we put a barcode on your cylinders, Michael, when you refill. I know exactly how much you consume, which frequency, and how much you save as a CO2. So carbon saving, carbon credit is natural things for LPG. A lot of research have been done between converting dirty fuel to LPG. So it's easy to convince people that LPG can save a lot of CO2 emission. The new innovation is, yes, with our model, and you can do a real traceability, because the problem is traceability. I know at any moment you can send a report to the investor, say, look, Michael consumed so much, like 12 kg, representing so much saving because he was using wood or paraffin, kerosene before. So traceability, digitalization in LPG will make things happen in carbon financing. And especially if infrastructures and CapEx is a challenge, even if for our gas partner or for traders, LPG traders, that they can, with carbon saving that they need to buy for, you can finance like last mile distribution in LPG. They can create a lowest infrastructures to sell more product finance with carbon credit. So there's a virtuous positive cycle, let's say, in LPG, because LPG, yes, is well known as a CO2 emission saving. So just the change, what is important is digitalization, so I can trace, I can do the traceability, and you make it credible, and you don't need to do inquiry after you also real time carbon savings through the digitalization. So that's, yes, it's clearly an avenue for financing clean cooking in LPG.
Very helpful. Similar question, Ben, to you, though I think you had mentioned that you already are very much plugged into carbon finance. And there was a question of, is there much demand for gold standard credits for biodigesters? Are you seeing a market there for biodigesters?
The short answer to that is yes. I think because of what's called co-benefits, as they talk about in carbon financing, you're not just getting the carbon offset, but all these other wonderful benefits to an end household. So definitely it's one of the more attractive gold standard carbon financing options out there. Obviously, you're never going to compete on the open markets where you're competing with, say, hydro dams or anything like that. Just, I think, don't know the price. I think it's like 20 cents a ton or something. It just doesn't really stack up. It's really at the higher end of voluntary credits that it stacks up. I think there's an interesting point that just relates back to what Philippe was just talking about. Is my understanding, I could have this wrong, is that the current view from a carbon financing perspective is they view and classify biomass use as carbon neutral, which is quite a sort of controversial point, I would say, as well, in that it's 100% sustainable. I ran into this problem talking to an expert at the UN a few years ago, because I was trying to get my head around how come there's no carbon emissions from biomass. And basically that was the conclusion that he sent through to me. If that's still the case, and I'm not an expert here, I think that does present an issue for a variety of modern cooking options where you're actually achieving a net carbon benefit. I know there was a report done recently saying the transition to modern cooking would reduce carbon emissions globally by about 2%. But I'm not sure if the baseline data is aligned with those recent findings. And I think the issue is the fact that I think there was good reasons why it was done in the early days, but the view of biomass as being 100% sustainable and therefore carbon neutral is obviously not correct. We're seeing large-scale deforestation in many developing countries. Bangladesh and Cambodia, for example, is huge deforestation, mainly driven by wood consumption for cooking from households. So I think it's an area overall that needs to be looked at, because that perspective around sustainability and biomass is, number one, incorrect in my view, and number two, it's stopping opportunities such as, for example, PayGo LPG to actually be able to access that kind of financing in the future.
Very, very helpful. So we have a few more minutes left, but maybe turning to the kind of the topic and the title of the session, right? So asset financing, pay as you go, and fuel sales, the future of clean cooking. One of the questions from the audience was around that future. And so if you look forward 3 years, let's say till the end of 2023, and this is the question for all of our three panelists, how big do you see pay as you go getting? So Ben and Philippe, that's a question for, how many households do you estimate you're going to be reaching with your business model in 3 years? And Lesley, for you, it's more, if you consider the broader Angaza platform, how big a share will cooking get? I mean, how many households do you think the PayGo can start to reach?
So I think if you project yourself in 2023, the only limit is of the scalability is investment required. So if you can and you are able to decapex at maximum, you create synergies, then scalability is quite natural. For us, is about we need to deploy 100 stations with our partner Pick n Pay, 100 with another retail store. For example, just for scalability, what we did since August. Since August, we opened 2 stations. 2 stations, we did about 4,000 clients, monthly clients. It's about 20,000 beneficiaries in like 90 days. So as soon as you reduce your capex, then you make it scalable. The only limits we can see is regulation. If in some countries they are not allowing partial refilling, they say, okay, I want full cylinders because make it true for the client. That could be the challenge. And it was a challenge in South Africa. We changed the regulation thanks to the benefits of PayGas, and it takes us about 4 months to include partial refilling, cashless partial refilling. So for me, is as soon as your solution require less capex as possible, and there's co-partners who are ready to invest, then and the regulation is adjusted, then there's no limits. And I'm sharing the same position than Ben is stop deforesting for cooking.
Understood.
75% of the urban cooking is done with wood and charcoal. So you don't need to go in rural area to stop the deforesting for cooking. So for me, scalability is only a question of capex and investment. So the lowest capex, so the easiest is the scalability.
Yeah, and we're almost on time. So handing the crystal ball to Ben, where do you see ATEC being by end of 2023?
Cool. One quick point. Wim over at S&V, who are a partner of ours, just said that there is an allowance for non-sustainable biomass in emission reductions calculations. So that's good news to hear. So we'll have to have a look into that more, but that's good to hear. As far as, well, I think let's not just look at 2023, let's look longer into 2030. I think the trend is going to be that everything is going to become PayGo effectively, or PayGo related in the near future. I think there's always a question. I mean, doing PayGo comes with a cost to the end user because there is additional technology integrations required there. So that doesn't come for free. So there will be a breakdown it'll be a race to the bottom from a cost perspective of either taking technologies to the lowest possible cost unit per possible, where you don't need PayGo, but it's as cheap as possible. Or the other option will be offering PayGo to break down that cost over time. So I think there's really only one of two directions it will go in the future for pretty much most technologies.
So I'm sure that's music to your ears, Lesley, but maybe for your final comment on how you see things moving in the next few years in terms of the uptake of PayGo for clean cooking.
Yeah, absolutely. I think Ben is probably right in terms of the sector really moving towards pay-as-you-go, and not just the clean cooking sector, but basically any sort of product geared at rural consumers. We see the rate of sales of distributors who sell pay-as-you-go increase by 5x versus direct sales where the consumer has to shell out a bunch of cash up front. And I think one thing that is important not to forget here is it's not just about acquiring a consumer in the first place, but we're seeing a lot of innovation again around thinking about consumer upsells. So even distributors who have been selling solar home lighting systems as the first finance product to that consumer, they now know that consumer, they know payment history, and then they're able to offer a cook stove either financed or via direct sales to that same consumer. So again, it's not just growth that's going to come from traditionally clean cook stove distributors, but also just distributors serving last mile consumers, offering a really wide variety of products in their portfolio.
Well, thank you very much, Lesley. I know we're a bit over time, and there are a few more questions we unfortunately did not have a chance to get to, but very interesting discussion. We are going to wrap here, but the organizers are asking me to tell you that the next panel will begin in 30 minutes. So just a big thank you to all of the panelists for a great discussion. Thank you, folks.
Thanks, everyone. Bye.
Thank you. Thank you.
Thank you.